Good afternoon. Good afternoon, everybody. My name is Kapil Gai, and I am the Senior Manager of Membership Engagement here at the Toronto Region Board of Trade. Thank you for joining us this afternoon for our valued member CBRE's workshop on Navigating the Future, Insights into the Downtown Toronto Office Market. Today's enlightening workshop will help us discover the future of Toronto's evolving office market with leading experts to gain insights and craft a competitive real estate strategy. Before we begin, I'd like to acknowledge this land on which we are meeting is home to diverse First Nations, Inuit, and Métis peoples. Though you could be joining us, and Métis peoples. The board's offices are located on the traditional territories of many Indigenous nations. They share with us a sense of responsibility for intergenerational equity, the well-being of today and tomorrow. And now, without further ado, I'll pass the mic over to Shekhar and Molly to get things started. Thank you, everybody.
Thank you, everybody. I am Molly Westbrook, the Executive Vice President over our Downtown Toronto branch for CBRE, and I have to tell you, we're really excited to be here with you guys today. Shekhar is over here to my right, and really will be taking you through a journey on what we're seeing in the office market. He oversees our research department for downtown Toronto and really has a great look at what's happening in the economy. Before we begin, we'd love for this to be as interactive as possible, or if you guys have a question, feel free to interrupt at any time. Like we said, we want to really make sure you're getting as much as you can out of the presentation today. So we'll take you down a few twists and turns, and hopefully you find this as fruitful as possible. So I will hand it over to Shekhar.
Thank you, Molly. So I just want to reiterate that feel free to stop me anytime if you have any questions regarding any of the slides, data. I'm more than happy to make this as interactive as possible. So before I get into the office data, I do want to provide a brief but candid commentary on the economic environment, as Molly mentioned. It's not a forecast, rather numbers that StatsCan is publishing. Now I know that the sentiment is negative currently. However, I feel that within office leasing, one often finds themselves in an echo chamber rife with optimism. There's nothing wrong with hoping for the best, but the following will help you prepare for the potential worst. With that being said, as the Canadian economy weathers a storm amid geopolitical tension, inflation is proving to be stickier than expected. Despite elevated interest rates, year over year in September, inflation has climbed up 3.8%, up from 2.8% in June of 2023. So let's sit back and examine that. Currently, interest rates are between 5.25 and 5.5%. That's a Fed rate or central bank rate. Despite that, inflation has gone up from 2.8 to 3.8%, right? Unemployment, as I'll mention later on, has also been climbing up and up. GDP growth is slowing down. All those signs lead to stagflation. To my earlier point, GDP growth has been slowing down on a year-over-year basis since January of 2023. In fact, year over year, January, we saw 3.2% growth in GDP, which is pretty formidable given what has happened in 21 and 22. However, that has dwindled down to 0.9% as of June of 2023. Unemployment is now 5.7%, right? This is up 70 basis points from the start of the year. So now let's zoom out from these fundamentals and examine the yield curve, because bond markets are excellent at predicting the future. We can see that there's still a differential between long-term and short-term bonds, with long-term bonds exhibiting a lower yield comparatively. Last time I checked, the 2-year US Treasury was hovering around 4.94%, and the 10-year is 4.537%. That is what's called an inverted yield curve. I'll go off on a quick tangent, but does anyone have any questions thus far regarding any of this economic data? Okay. So in terms of the inverted yield curve, what ends up happening is it's always a big money that drives the yield curve and the bond markets, right? So funny enough, the yield curve was inverted, I believe, in August, September of 2019, well before the pandemic, because well before they declared the pandemic, the big money was, they encountered a flight to safety. They were selling off equities and buying long-term bonds. So what happens is, as you buy long-term bonds, the prices go up, and since yields are inversely related to prices, the long-term yields go down. You add that to the fact that the central bank is raising rates, which causes shorter-term yields to go up. That causes the inversion to be more and more pronounced over the years. So that's why the yield curve is inverted. And 9 out of 10 times that does signal a recession. I'm not saying we're going into a recession, but the signs are there for a potential downturn in 2024. So let's turn things a little bit more bullish now with that wonderful intro. What is the main thing driving the office market? It is office occupancy rate, right? So if no one's using the office buildings, there's no point in having office buildings or leasing office buildings. Speaking about vacancies, rental rates. So as of October 15th, according to SRRA, Strategic Regional Research Alliance, the office occupancy is 55%. That's in downtown Toronto from the Water to Bloor. So when you see 55%, that's 55% of pre-pandemic utilization rate. So in pre-pandemic, about 70 to 75% of tenants were using office space, meaning they were in the office 5 days a week, 4 days a week. Right now, we have 55% of that. The peak day is Wednesday. Most of the people are in the office on Wednesday at 71%. Slow days Monday at 29%. Again, I want to reiterate, this is a fraction of the pre-pandemic average. This is not an absolute 55%. It's 55% of the 70% encountered in 2019. The good part is it has been going up. So since January of 2022, we're at 78%. It has since steadily increased to 55, right? So now let's put this number in context. How does it stack up against other major North American cities? You can see for much of 2022, I'll tell you that Toronto was dead last, but as of late, we're only behind Houston and Austin at 55%. So we are slowly climbing the ranks. So what is driving this occupancy? Let's look at the return to office status of major companies. The most recent one that I heard was Zoom. Ironically, the very company that popularized video conferencing, work from home, stay at home, they want their employees to come in 2 days a week, right? So I think this is the canary in the coal mine, if you will, that even if companies like Zoom, Snapchat, other tech companies, Starbucks, Bell, etc., if they want to use the office, there's a clear use case for the office, right? Humans, as you know, are social creatures. We need a place to gather, socialize, collaborate, etc., right? I suspect this trend to continue forward. What I do hope for is RBC doled out a mandate at 3 to 4 days a week. I am hoping Scotia, CIBC, National Bank, TD take note, because these are the banks or the occupiers that drive our office market, right? In Toronto, at least. Moving on, let's switch to the supply side of the equation. So let's look at vacancy rate. Now, I'll take you back to March 2nd, 2020, right before the pandemic. The downtown Toronto vacancy rate was exceptionally low, one of the lowest vacancy rates in North America at 2%. This is a very strong landlord's market, right? At 2%, the landlord can command whatever, right? There's no TIs, there's no free rent, nothing. You have to pay the sticker price, there's no negotiations, right? Since the pandemic happened, we've gone up all the way to 16.1%. Interestingly, for much of 2023, we ranged between 14.8 and 15.4%. And I personally thought that vacancy would not go too much higher. However, as of late, due to a higher amount of direct space being reintroduced to the market, not sublet space, but direct empty space, we've since gone up to 16.1%. We have several in-house estimates of what the vacancy may or may not be by the end of the year. They range between 18 and 20%. What I will say is the inventory size, office inventory for downtown Toronto is 80 million square feet. So each percentage point is 800,000 square feet. So from 16 roughly to 20%, we need 3.2 million square feet of currently available vacant space for it to reach 20%. I don't foresee that happening. Great question, Kathy. So the occupancy slides go up to Bloor. This is strictly downtown. This goes up to downtown north. So I would say the Mars building, 777 Bay College. Exactly, yeah. So just shy of Bloor. Sorry, the clicker's a bit delayed. Got it. Only took 5 tries. If you look at the vacancy, right? If you look at the top 5 landlords, right? So we talked about the overall vacancy. That consists of 80 million square feet. If you look at the top 5 landlords, they're doing fairly well because the top 5 being Cadillac, Fairview, Brookfield, Oxford, Allied, Kingset. Just Class A, we're looking at 8.1%. That's about 36 million square feet. And this is what you call the cream of the crop, right? This is the center ice, if you will, financial core, greater core. They're holding up quite fine. You can see some of the buildings over here, Scotia Plaza, 161 Bay, etc. So I highlight this slide to kind of point out the flight to quality or flight from commodity, right? Anytime you have some sort of market downturn or peril, there will be a flight to quality. And when that happens, premium product will perform better than inferior product. Now, we talked about direct space increasing the vacancy. Let's talk about sublease space. Why is sublease space so important? Sublease space is a leading indicator of an upturn or downturn in the office market. Typically, what ends up happening is before vacancy goes higher, what tenants will do instead of evacuating their space or vacating the space, they will start marketing their space on the sublease market, all right? So before the pandemic, the sublease share was exceptionally low. It was below 500,000 square feet. It represented maybe, less than like 20%. But since the pandemic happened, the sublease share has skyrocketed, if you will. Most recently, we're well above 45%, and we're sitting at about 3.8 million square feet of currently available sublease vacancy, which represents 31.7% of the overall vacancy. Now, typically when that happens, it's a leading sign of a downturn. Previously, this happened in Q1 21. To me, this is a point of max fear. Let me take everyone back to Q1 2021. This was right after the pandemic. So let's say the pandemic is declared Q1 2020, towards the end, March, April. You have the whole year of fear. Vaccines aren't really out yet. In Q1 21, they start talking about the vaccines. Newer variants are coming out. We don't know when we'll go back. We don't know when the lockdowns will be over. At the point of max fear, sublease space represented 43.7% of overall vacancy, right? Then vaccines came out, fear was alleviated, sublease space went down, confidence returned to the market. But now, why is it going back up? Recessionary fears, right? Before it was a healthcare concern, now it's an economic concern. So this is very much sentiment driven as well. Yes. Great point. Great points. Yeah. So, sorry, I didn't get your name. Pete. So Pete said was, you have companies which have employees coming in about 2 to 3 days a week, right? And as a result, they didn't use all their office space, so they opt to sublet some of their space, right? Now, that could happen, but as long as people are coming in on a peak day such as Wednesday, perhaps even Tuesday, I do not see a material downsizing in the office footprint for most companies, because at some point in the week, they would have to accommodate all, if not most, of the employees. So while companies will right size, that right sizing can be downsizing, can also be upsizing, I don't foresee a material shedding of space in the office market as of now. The reason why I'm so confident is because occupancy is going higher. It went from 8% to 55%. So people are still very much aware of the use case of the office, and mandates are being doled out organization by organization. But yes, that is a valid point, Pete. Thank you for that. So now, diving a little bit deeper into the sublease space, let's look at the sublease expiry profile, right? So why am I looking at the expiry profile? Because if you look between 2023 to about 2027, that represents about 60% of the sublease square footage, right? This is like near-term space. So this is stuff that's set to expire within 5 years, right? Short, turnkey. This is a space that will attract the companies looking for flexibility. But beyond that, 40% of the sublease space, right, is set to expire 5 years or longer. Why is this important? This will compete with the newer direct listings. So this is the competition that the new builds will have to deal with, such as this building, 100 Queens Quay, right? Excellent development, but you have subleases on the market which are already built out. They have furniture, they have all the furnishings, etc. And they offer a discounted rate and perhaps even a shorter term because tenants are trying to get out of their lease obligation. So that's why 41.3% of the sublease square footage is fiercely competing with the direct space. I mentioned this before a little bit earlier. Let's look at flight to quality. I mean, you guys know the message over here. Top 5 landlords, overall vacancy, Class A, 8.1%. Again, anything below 10% is considered, I would say 5 and below is a strong landlord's market. 8 to 10 is a balanced market. Anything beyond that is a tenant's market. So in terms of top 5 landlords, Class A, we're fairly balanced at 8.1%. If you look at the trophy assets, we track about 13, 14 buildings in downtown Toronto, which are AAA, such as 161 Bay, 40 Temperance, 333 Bay. Those vacancies are exceptionally low because they are the cream of the crop, if you will. They're at 5.5%. Now the buildings, which are a little bit inferior, built before 2009, older product, they're 17.5. Newer product is 8.6, right? So it all kind of adds up. Newer, higher quality buildings, lower vacancies, older product, less demand, right? You get the picture. A lot of people like to ask whether or not new developments will have a material impact on vacancy, right? If you just look at this picture, you look at all these buildings going up, 530 Front, T3 Bayside, CIBC Square 2, you have hundreds of thousands of office square footage being reintroduced to the market. Now, if this was 2019, this would make sense because back then, the under construction pipeline was between 9 and 10 million. Currently, it's about 5 million. Because there's a dearth of demand, we don't necessarily need new developments. But would this make vacancy spike up? Not really. Because if all these buildings complete and they come online, right, if you look at the 810,000 square feet at CIBC Square, 530,000, you'd only have about a 1.8% impact on vacancy rate if these buildings come online and they're not leased, right? So the odds of that happening are very small. I can tell you right now, there's a major deal happening in this building. I just can't speak on it. It's a CBRE deal. But this building will have a vacancy much lower than what's projected here, right? It'll have much higher occupancy than 43%, right? So sooner or later, 530 Front, T3 Bayside, all these will gain some traction. Now, finally, not to go down the vacancy hole too much, but I do want to talk about where the vacancy is originating from. Based on my discussion thus far, it would make sense to assume that the inferior product is primarily responsible for raising the vacancy, right? It's always the periphery buildings, the lower quality buildings, but that's not the case. Yes, it does come from the inferior assets, the periphery assets, but if you look at the downtown inventory, out of 80 million square feet, 50 million is Class A product. So mainly a Class A type of market, right? Within the Class A product, there's a lot of right sizing, as I mentioned. There's a lot of bank consolidations. There's a lot of sublease space. In fact, because of all that, 7.3% of all buildings in downtown Toronto are responsible for 41.1% of the total vacancy. That means 29 buildings account for about 4.9 million square feet of vacancy, right? So this ties back to that 16.1% number. That 16.1% number, 41% of that comes from 29 buildings. Large part of that is being driven by bank reconsolidations, right? You heard about CIBC Square, TD moving into 160 Front, Scotia subleasing a bunch of space at 720, Spadina, et cetera, right? So these are the major occupiers. And banks, I think they make up more than 10 million square feet of downtown occupancy in Toronto. Let's talk about demand. So we talked about supply, we talked about vacancy, we talked about how vacancy is going higher, we're not in the best place. But are people still leasing office space? Yes, they are, right? If you look at month over month, we had a bit of a record month, November of 21. At the beginning of 22, we had record months, right? Over 600,000, over 700,000. Since then, we haven't seen these blockbuster numbers, but we're averaging about 300,000 square feet per month. So yes, while there's a lot of gloom and doom in the media, currently in 2023, by the end of the year, we're set to be around the same ballpark as 2022. Why is that a big deal? 2022 was a record year for CBRE in terms of office leasing. So while media does like to spin gloom and doom and the sky is falling, people are still leasing space. People are renewing space, primarily fire companies, right? Financial companies, also legal firms, Dentons, McCarthy's, all doing long-term renewals, 200,000 square feet plus, 10 years, 15 years. So there is faith. And what you have to do is you have to look at the numbers. You can't just look at the headlines. Kind of have to pop the hood and see what's really going on. If we're averaging 300,000 square feet per month, the sky is in fact not falling. So now let's look at where the space is coming from. Most of the space that's coming back to the downtown market is coming from downtown west market. Does anyone want to guess why downtown west is primarily responsible for most of the space? Would anyone venture to guess? Why not the financial core? Why not these A-class buildings? The well? Good guess, good guess. About 40%. What I would say is the well is a big part of that space, but a second part of the equation is that most of downtown west is brick and beam assets, right? They're a little bit older, a little bit more antiquated. Also, the tech market is suffering a bit of a downturn. So you combine those two factors, means the downtown west and Liberty Village markets are suffering. Now, Liberty Village is all the way at the bottom because its inventory is very small, but proportionally, they are giving back a lot of space. Where is activity happening? Where is space being transacted? Of course, financial core, right? Center Ice, about 1.3 million square feet. Most of the space transacted in 2023 has been the financial core. Now, what kind of space is being transacted? We know it's in the financial core. We know downtown west is giving back space. But because of the high interest rates, because of the high cost of capital, occupiers do not want to spend money in building out space or in investing in the space. So they opt for subleases, as I mentioned earlier, but they also want built-out space. In fact, in 2023, 74.4% of all transactions, square footage-wise, occurred in built-out space, right? They want flexible, shorter term, built-out space, turnkey. I don't want to spend any money. I want to go in there, just start working, right? Number was a lot higher in 2022. 85% of all transactions occurred in built-out space. Now, I'll turn it back to the audience. Do you think it's a good sign that the proportion of built-out space is decreasing, or is it a bad sign? There's no right or wrong answer. It can be subjective.
Do you have a prize for them? No.
I might. You can have this clicker that doesn't work.
The only place deals are being done, in my experience, is in built-out space.
Yes.
So the factor is becoming less of that available. The amount of demand for that is going to outstrip what's available. So again, if you're looking to do a deal and you've got built-out space, you're in the driver's chair. If you're sitting on a lot of vacant space, you're going to whistle Dixie for a long time.
Right.
Exactly, exactly. So what's happening is people still want built-out space, but there's only so much built-out space, right? So once that runs out, people start opting for base-built space. Now, typically, that's a good sign because people are willing to still take the space and invest their money because it shows confidence in the office market. So as this number gets lower, it's actually a bullish sign for the market. But to your point, if they had a choice, they would still go back to built-out space. That's very true. Thank you for that. So we know they want built-out space. What type of industries drove demand in 2022? We knew it was a big year for tech, but also fire, because most of S&P is fire companies, financial companies, and business services. These are three industries which drove demand in 2022. In 23, the narrative shifted slightly. Shifted slightly. It is now legal, education, and technology. So I mentioned a couple of the legal firms earlier, right? We looked at Dentons, McCarthy's, Airden Burles, all doing long-term renewals, 10 to 15 years, 180,000, 200,000, which is a good sign. But education kind of flew under the radar. I can literally name every major educational institution that has done a deal between 21 and 23. McMaster, Ryerson, U of T, Ivy, right? ILAC, you name it, Northeastern University. They're all doing deals. So education's a big part of the story. And tech hasn't gone anywhere. I know we had a tech crash, but TAMI tenants, at least the smaller TAMI tenants, are still taking space. Large occupiers, to your point, such as Shopify and The Well, are kind of sitting on their hands. But the smaller startups are still taking between 5 to 10,000 square feet, they're still very much active in the market, which kind of makes sense because if you look at my previous slide, in the space transacted, West hasn't completely disappeared, right? In 2023, 625,000 square feet of transactional activity originated from downtown West. These are the TAMI tenants that I'm talking about over here, right? So it kind of makes sense. Now, I mentioned sentiment before. A lot of things drive sentiment, or sentiment drives a lot of things, I should say. It drives rental rates, it drives leasing terms. So let's look at what the average lease term is. Let me take you back to 2019 during a peaking market, right? So the average lease term back then was about 80 months, right? You get the pandemic happening, you have max fear. By Q1 21, it goes back down to 43 months. Now we start talking about vaccines, confidence starts coming back to the market. By Q1 22, we're up to 58 months, right? Almost 5 years. Now what happened in Q1 22 that caused this downturn? Does anyone want to guess why it went from 58 to 52 between Q1 21 to Q1 23? It's something that the central bank did, yeah. Exactly, exactly. When they started raising interest, look, we've had 15 years of pretty much 0% interest rates, right? Like free money. It's been a money printer for the last 15 years. When you start hiking rates and people are used to free money, they start getting nervous, right? The cost of capital is higher, right? Recessionary fears start growing. That's why the sentiment turns negative. It goes back down to 52. But then we're up to 61 and 54. Why is that? Because they're talking about a soft landing, right? So Jerome Powell, Tiff Macklem, they're all trying to engineer a soft landing. In fact, their last 3 decisions, I believe, were at a pause. So they're not exactly raising rates. I don't suspect that they'll raise it again in December, but then again, they might, maybe a micro raise 0.25 basis points, but it is what it is. We're already at 5.25 and 5.5%. I don't think we need to go higher because with the interest rates, they take their time to kind of affect the economy. It's not immediate, right? So one has to be cognizant of that. I'll end off with an outlook, but before I get to the outlook, does anyone have any questions about anything I said? Okay. So let's look into the future. Everyone wants to know about rents, which way rents are headed, right? Because we're all worried about how much we're paying for office space. In my humble opinion, I would say the rental decline is accelerating. In fact, it has just started. For the first time since Q1 2020, rents have now finally started to decrease in terms of asking net rents, right? So since Q1 2020 to Q4 2022, rents have been going up and up and up, right? Now, one would question, why have rents been going up in the middle of, a pandemic? Reason being because higher and higher quality office space is coming back to the market. They're advertising at high rents, Class A space is coming back, and that's what causes the asking rents to go up. But in the midst of all that happening, vacancy is also being elevated, right? We went from 2% to 16.1%. So vacancy affects rental rates in a lag manner. So we had 2 years of increasing rents. Then finally, Q2 23, we had our first decline, and Q3 23, we had our second decline. In fact, from the start of the year, rents have decreased 3.8%. So weighted average asking net rents in downtown Toronto have decreased 3.8%. It might not sound like a lot, but it's our first decline, I would say, in almost 15 years, right? Yeah, you have blips in the middle, but this is a material decline. So which way do you think rents will go? Perhaps we can use the previous downturns to kind of ascertain or try to ascertain which way rents will go, right? So let's go back to the dot-com crash. In Q3 2001, rental rates in downtown Toronto were $20.95. When the dot-com crash happened, space started coming back to the market. As space comes back to the market, rents go up. They went up 1.9%. And then between Q2 2002 and Q2 2005, again, lagged slow market, rental rates decreased 16.9% over 3 years. They went from $21.35 to $17.75. That's a 16.9% decline due to the dot-com crash. That's downtown Toronto. Let's go back to the GFC, or GFC1. Hopefully there's not a 2, but there might be. In Q4 2008, we have 2359. Again, they declare the great financial crisis. Space comes back to the market, rents go up initially. They go up 6.5% to 25.13. Then, over the next 6 quarters, rents decreased 9.5% to $22.74 in downtown Toronto. Now, I told you before, rents have been going up until Q1 2023, where they peaked at $36.04. Let's take an average of the declines, negative 9.5, negative 16.9. Let's take an average of the time frame, 6 quarters, 12 quarters. So therefore, over the next 9 quarters, we should roughly see a 13.2% decline in rental rates from $36.04 to $31.33. Again, yes, we'll see a decline. Yes, there'll be a market softening. Yes, survive till 25 is very much still true. But all that to say this, the sky is not falling. And with that, I'll open to any questions, comments, anything you want to say. Please. I can hear you. Yeah.
Last week we heard a little bit about WeWork. We want to see if there's any engagement risk or not because, obviously it's going to go up. Obviously tenants will obviously be affected. So how is that going to be bridged? I don't think a lot of issuers are cash rich at this point in time at all, given that we're high interest environment. But how do you see that bridge happening?
Yeah, so I think both Molly and I can comment on this. So first, let's put this WeWork insolvency in perspective. Let's put this WeWork insolvency in perspective. WeWork has roughly 600,000 square feet of office space in downtown Toronto. To put that in perspective, total office inventory is 80 million square feet. So if WeWork releases all their space, reintroduces it back to the market, vacancy will go up about 0.7%, right? So yes, WeWork is not doing well. We've known that for a while. They needed cash injections from SoftBank. We kind of saw that coming. But it's not like, even if the entire co-working sector were to collapse, which I don't foresee happening, the entire co-working sector represents between 3 and 4% of the total inventory. As far as how the landlords are doing, yes, some of the smaller landlords are struggling. They're certainly not cash rich. But luckily for us, about 65% of the ownership in downtown Toronto, and I can share the slide with you, is through institutional ownership, right? Pension funds. So they do have deep pockets, and they are prepared to weather the storm or survive till 25. So yes, rents will go down. You know what? I'll even go so far as to say that the office inventory may shrink a little bit, not materially, but a little bit. It might not be 80 million square feet. It could be 77, could be 76. We could see some conversions, although conversions are not easy, whole different topic. But it's not like the office market will implode. That's my 2 cents. You're welcome.
Any other questions?
Great question, Kathy. So what I will say, it's a little bit of both, right? So what is driving the rental rate decrease? It's going to be the inferior buildings. They're going to suffer disproportionately to the AAA buildings. That being said, given that the macroeconomic factors are all bearish, right? Unemployment, inflation, etc. I think all classes will suffer, but class B and C will suffer more so than AAA. Yeah. Highest rent. Okay, so it's a bit of a tough question. I'll try my best to answer it. In terms of averages, if you look at average downtown rent, that's all classes, that's $36.04. That's in Q1 2023. Class A average asking net is about $38.39. But if you look at AAA buildings, let's say if you look at what CIBC Square 2 is demanding, 40 Temperance is demanding, you can see $60, $65, up to $70 asking net rent, right? But the thing is, it's wrong for me to just only examine asking net rents because in this environment, tenant inducements play a big part in what actually hits the landlord's pockets. So these TI packages, which result in taking the asking net rent to net effective rent, I think they should be considered. And the TI packages are very large, especially in this climate. $100. I've seen all the way up to $200.
These rates are including the net rent as well as the operating cost?
These are just net rents excluding operating costs and also excluding the TI packages, just simple net rents, yes. Yeah, additional, to give context, additional is about between $25, $29 for downtown.
Any other questions?
Did anything we say shock you guys today?
I hope I didn't offend anyone.
Actually, I actually do have a question, and maybe you might have answered this early in the presentation.
Sure.
But I'm really curious to know about short-term leases. I know like a lot of co-working spaces. It's kind of like it's like this culture of like pop-up workspaces. What can you tell me about that? In case you didn't answer that before, but I'm just curious and learn a little bit more about that.
So short-term leases are becoming increasingly popular because tenants demand flexibility. Also, a lot of these occupiers are very intelligent and they do know which way the market is headed. You know, this little calculation that I did was done several months before, and people know which way rents are headed. So they know that I don't want to be locked in for a 5, 10, 15-year term unless my company has sufficient going concern, right? In terms of shorter term leases, there's two kinds of short-term leases. One you get with co-working, there's the one you get directly with the landlord. One with co-working, if your company's small enough, a short-term co-working lease makes sense. Anything past a certain size, now anecdotally, that size could be 3,000 square feet. That's what I've heard through some of our brokers. Anything past that, co-working becomes prohibitively expensive, right? Also, there's a lack of privacy. Certain organizations cannot use a WeWork, right? Banks need firewalls. They can't just all, jam in a WeWork, right? So they will need to do direct short-term leases. And yes, the average tenure of the lease is going down, right? Pre-pandemic, it was like 7, 8 years. Now it's less than 5. And I do suspect that trend will continue because more and more, I think the use case of the office is evolving, right? So hybrid work is here to stay. And with that comes a need for flexibility. Wherever there's flexibility, there are shorter leases.
So, like for a business model, where can businesses find longevity in that? Because it is, short term can, I'm sure it can have great impact now, but longevity-wise, how would a business pivot to deal with that?
When you say business, are you talking about a landlord? How would
Yes,
a
sorry,
landlord-
landlords,
Yeah, yeah.
yes.
So landlords can succeed by kind of customizing their space to a particular tenant to kind of entice them into signing longer term leases, or they can adopt a one-size-fits-all strategy where you have a singular floor that's fit for 2, 3 different tenants. So you got Monday, Tuesday here, Wednesday, Thursday over there, and Friday you got a guy coming in 1 day a week. So several different, not several, there's a couple different strategies they can use. But that being said, at the end of the day, it's all about location, it's all about operational excellence, it's about amenities. As long as you have those 3 things in place, lease flexibility will not materially affect your business.
Okay, perfect. Thank you. Thanks for answering those questions.
Go ahead.
Space is vacant, and nowadays the city of Toronto, they charge, there's a penalty if the space is left vacant.
Mm.
Do you think that there's going to be any decrease in the taxes if the space is vacant in the building? So the city comes and takes property tax.
So would the tax be imputed if we have
Yeah.
vacancy in the space for long term?
Yeah, I mean, look, we know that the government is in a deficit. They're finding every way to collect more money from us. So I think that will happen, right? And I think that will put pressure on the landlords if they have vacant space. That being said, leasing activity hasn't quite fallen off a cliff yet. We're still averaging 300,000 square feet. So while that may be true for certain buildings, I would say in the periphery markets, Class B buildings, Class C buildings, low-rise buildings, I don't suspect an asset like 161 Bay, like 40 Temperance, like, even the Well, right? I don't suspect they'll be paying a lot of vacancy tax because they are garnering a lot of attention and tenants do want to kind of house themselves in these higher quality buildings. I hope that answers your question. Okay. Please go ahead. Yes. I did. So, no, that's okay. Let me go back to the slide. So the clicker decided to work at the end of the presentation. Perfect timing. Occupancy rates are 55%, if I recall. Now again, this is 55% of a pre-pandemic average, which was 70%. So a lot of people are under the misconception that 100% of office occupiers were using the buildings pre-pandemic. That was not the case. In fact, here's a fun fact. Office occupancy has been declining since 2013, but that's more of a function of technology, right? That's just natural evolution. That being said, there's still a use case for the office. So when you see this 55%, that is 55% of 70, or roughly 36, 37% occupied in downtown Toronto. That's up from, 7, 8% in January of 22. So while the number itself is not high, the trend is positive. Yes, sir.
Do you foresee a sweet spot for negotiating for tenants with clusters of 9-quarter duration?
I do, and I also realize I'm being recorded, so, I'll tell you, it's fine. I do think rents are declining. You can negotiate a favorable deal right now. However, if you were to wait a quarter or two, it's not going to hurt you. Again, don't take my word as gospel, but I do foresee 2024 to be a rough year. And there will be a sweet spot, particularly Q2, Q3, 2024, before we get what's called a mercy cut from the Fed, which I do foresee happening. And I think that is, I don't want to call the bottom, but if I were to call the bottom, someone put a gun to my head, that would be the bottom before the mercy cut. So right now is a sweet spot. It could get sweeter. That's just my opinion, not CBRE. Definitely in the lower quality buildings, more so. Because if you look at the AAA buildings, between the 13, 14 AAA trophy assets, we're still at...
Beautiful.
Thank you for the theme music. AAA buildings are still 5.5%, so there's not a lot of room for negotiation at 5.5%. It's still very much a landlord's market at that point. Even the newer assets, they're at 8.6%. The top 5 landlords are at 8.1%. So definitely in class B and C. Yes, now we're getting into like different asset classes. So Mississauga it's more industrial, right? So Toronto West, Toronto North, Toronto East. Yeah, like the industrial market, it's the complete opposite of the...
Fire.
Yeah, it's on fire. It's peaking. It's the complete opposite of the office market. So, these guys are making money hand over fist, right? Our day is yet to come.
I actually, that sparked another question for me. When you look at like the downtown office market, what other markets, I guess, would be competing markets right now where organizations might say, you know what, we're going to close up shop in the downtown Toronto market. It's too expensive. We want to go to perhaps Mississauga or Kitchener. Like what other markets right now would be competing, if you're aware of?
That's actually a great question. And in theory, it makes sense to close up shop in downtown and get cheaper rents in Mississauga, cheaper rents in Brampton. But again, the 3 factors that determine whether or not employees even use the buildings is location, operational excellence, and amenities. It's hard to find those 3 factors, kind of dovetail each other in a Mississauga, in a Brampton, in...
And transit.
Transit, that's huge.
a very big factor.
4
is what
factors,
we're
yeah.
saying. Yeah.
So, yeah, you can close up shop, but it's not as simple. Yes, you'll pay a lower rent, but will you receive the same type of attendance? I personally don't think so. I think there's a reason why downtown is called downtown. There's a reason why they call it Center Ice, several other nicknames. I don't foresee people using the hub and spoke model, if you will, and kind of relocate to the suburbs. I know Scotiabank has tried that. It hasn't worked as well. Yes. Yeah.
We were waiting for that one.
Yeah, I can't believe it took an hour. But I don't foresee a lot of this stuff being converted to residential housing or multifamily high-rise. Reason being, it's very cost prohibitive. Number one, even if you could convert these buildings, the cost of borrowing is so high. I mean, the central bank rate is 5.5%. On top of that, office buildings are very much different from residential buildings. You have elevator shafts, you have lighting, you have bathrooms, you have plumbing. It's not a simple conversion. So while we are seeing a few conversions, it's anecdotal evidence of smaller low-rise buildings. I can't just take, you know, a First Canadian place and turn it into residential. So it's tough at this point. It does happen in the States, but mind you, office inventory in some of these other markets, such as New York, Chicago, is much higher than that of Toronto, right?
And you know, across Canada right now, there's the case studies in Calgary, but those were incentivized by government funding, right? That's definitely an additive to that. So I don't think we're seeing that here in Toronto quite yet.
You're welcome. Ma'am, you had a question? Just right behind you. Yeah, I'll give you a great reason. So people are creatures of habits, right? So the brain likes to stay in what's called homeostasis. That means it kind of resists change. So if you remember in 2020, what were people being opposed to? Was it the lockdown or was it going to work? People did not want to be locked down. People did not want to wear masks. Now what has happened over 3 years? People almost want to be locked down, right? They want to work from home, right? It's because they got used to it, right? So another factor that's determining whether or not people come in or not is transit, right? Safety. Also higher costs, cost of traveling, right? Even as simple as waking up early. No one likes to wake up early. I'm not a morning person. There might be morning people in the room, but I don't like waking up at 5, 6 a.m. You know, I do it because I have to. But don't tell my boss. So yeah, those are my factors. And I think through the passage of time, the habits will also change, right? I think the habits are changing because the occupancy is going higher. So people, you know, humans being social creatures, they are finding ways to get back in the office. Probably won't be 5 days a week, likely will be 2 to 3 days a week. But again, it's a start.
But I mean, we're back in 5 days a week. We're a real estate company. We're back in 5 days a week, right? You have to have that connectivity. We're seeing more productivity. We're proponents of the office space, so that's a big factor for us. Yes.
Yes, so here's the thing about productivity. A lot of people say I'm more productive from home, but if you look at these studies, these are self-reported statistics. Like, I'm not going to say I'm less productive when I'm saving on bus fare. I'm going to say I'm more productive, right? It affects my job. Now, the productivity studies, they weren't very prominent pre-pandemic because there's no reason to have those studies. We are seeing more and more studies being rolled out, and in my opinion, I think office is more productive than home because it has withstood the test of time, right? Offices have been around for hundreds of years, and the reason for that is because humans need a place to gather, to collaborate, to discuss, and also a quiet place to work that's free of distractions such as a dog, kids, laundry, et cetera, et cetera. So I think over time, offices will prove to be productive.
I have a question. As the GTA expands, you know, more parts of the GTA, there's more housing being built around GO stations, around other transit. You know, that's, you know, more population, of course, being added into the region as well. How has that driven occupancy rates, and how has that driven more people coming to the office, and what has kind of been the feedback on that?
Repeat, like as GTA expands.
As the GTA expands, more
Yeah.
people are buying homes, you know, out
Yeah.
in the outskirts of the
Right,
GTA,
right,
perhaps
right.
Pickering, Innisfil, Barrie, and a lot of people actually work downtown in the downtown core. So
Right.
can you talk more about that relationship, the
I will.
correlation there?
So what's happening is initially as people, so a great time to buy a house was 2020, right? Because since then, the real estate market, the residential real estate market has seen astronomical returns, right? So I think that trend is kind of slowing down. Between 20 and 22, of course, that has negatively affected occupancy. Occupancy would have been a lot higher if we didn't have all this cheap housing. But now the house prices are kind of catching up. People aren't really buying too many homes in the periphery market, or at least not at the same rate, right? So since that trend is kind of slowing down, I think more and more people are choosing to stay in their current locations. It could be close to downtown. On top of that, more and more organizations are waking up and kind of issuing mandates. So you have two factors, right? Two confluencing factors that are influencing occupancy. So I think over time, occupancy should go higher. Will I personally think if it'll reach pre-pandemic levels? No, because we have what's called a systematic change. The office has evolved. We're not going to hit, like this will never say 100%, Because 100% here would mean 70% in pre-pandemic, like 2019 numbers. But will we get close? Likely.
And
Do you have, or are you aware of anyone that's trying to start to collect data on occupancy on a more granular level to look at like the effects of pod desking and that kind of stuff on
Great.
the demand for space?
Amazing question. You know, I asked myself that question. I wish I could do it. But Strategic Regional Research Alliance is looking at data on a building by building level. That's something that they're working on, right? They haven't officially rolled it out, but that is the next step. Because we want to know where the occupancy is originating from. This blanket number is nice, but let's look at what's driving occupancy, what other factors, whether it be location or hot desking, to your point. I think that'll help us understand the data a bit better.
any other questions?
What was the main reason, what are the differences between the natural evolution factors that drove the occupancy pre-pandemic versus post-pandemic, like 70%? And why wasn't it 100%?
Right, because in 2019, we still had access to Zoom. There's still tech companies working from home. It's still the natural evolution. There were remote workers. There was outsourcing still around. So it'll never be 100% because technology has evolved. In fact, occupancy has been going down since 2013, right? Interesting point. When Netscape Navigator was rolled out way back in the day, they said everyone would work from home. But Netscape Navigator, if anyone remembers that, internet app, right, way back in terms of Apple Macintosh, that only reduced office occupancy by less than 5%. Right, so as technology evolved, it went from 100 to 70, but I don't foresee it go any lower than that.
So were people staying home and therefore being more productive with more technology?
It's not about being productive, it's the fact that they had the option to stay home and complete their jobs from home, right? It's not so much so that I'm going to stay at home because I'm 20% more productive. That's not the line of thinking. It's that I'm able to do my job, I'm able to fulfill the requirements on my laptop because I work for a tech company from home, and I can save on transit, get maybe half an hour of extra sleep in, whatever the case may be. I personally can't answer that question. In my humble opinion, I'm pro-office. So I'm going to say no. But,
But maybe you could speak to, just because we are a global real estate firm, it's probably interesting for you guys to hear what's happening around the world. Like, what are we seeing like in Europe? Didn't we say that we're seeing them kind of fully back, right?
Europe, London, they're all 100% back. I mean, they've reached their pre-pandemic occupancies, and the trend certainly is telling us that we're headed in the same direction. But I'm being more conservative in saying that we're not going to reach full pre-pandemic levels, right? But could
I'm
happen.
being more optimistic, so there you go.
Why do you think it's the trend has? Why do you think that they've moved back to fully in office quicker than North America or quicker than we have?
Yeah, so I think a lot of this has to do with the severance laws and like the employment laws, right? So the employment laws in New York and London are much more strict than here, right? It's I shouldn't say this, but it's a lot easier to fire people, these major companies in New York or London than it is over here. So definitely there's more fear in the market. Also, the recession is hitting London a bit more than it is over here. So the economy and also employment laws. Great point. Like our public transit system compared to Europe is night and day, right? They're much more developed. Even the U.S., right? They're much more developed, and that certainly helps them drive the occupancy figure higher. That's a great point. Once they're done, sure. I'm not holding my breath. No, but that is a great point, though. I think once the GO train expansions do complete, I think it'll definitely give some tailwinds to us. Go ahead, sir. Yeah. Yes. Yeah, 1.8%. If nothing is leased in the new supply. Yes. Great question, great question. So I did like a small sensitivity analysis. Let's say, you have three major buildings, right? You got T3 Bayside, 251,000 square feet. You have Portland Common, 560,000 square feet. And you have CIBC Square, about 1.4 million square feet. Of that, about 620 is left vacant, right? Let's say you have a major tenant, three major tenants that take 100, 100, 100. Rough back of the napkin math, or back of the envelope math, would say that 1.8 turns into 1.5% increase. And I do suspect someone will take space. In fact, like I mentioned earlier, I can't talk about this too much, but there is a large occupier looking at CIBC Square 2, which is 141 Bay. So it's not like all these buildings will come online in the same vacancy state as they are in right now.
Any questions?
If you had one piece of information to kind of help you get a more accurate forecast of the distribution of the trough potentially changing, and what do you wish you knew to kind of like have the most accurate outlook you can get?
You got it, man. You mentioned this earlier. It's the occupancy, but a more detailed study of occupancy, like where is it originating from? Because to me, office use and occupancy drives everything. Like that is a linchpin to my argument. If I know which buildings are driving occupancy, I can figure out why they're driving it, which factors are present in these buildings, right? Once I have that, I know which way vacancy is headed, I know which way the rents are headed, and I know which way absorption is headed, and from that I can ascertain a whole bunch of things. So if I had a detailed breakdown of occupancy on a building by building level, or even sub-market, I think that would help me greatly.
Shekhar and Molly, is there anything that we didn't cover? Or maybe there are some questions you're hoping would be asked. Anything else you want to bring out, or anything else that we should know? Any advice?
Well, we don't have a crystal ball, but we are feeling optimistic. I think we gave you this from a downtown perspective, but you guys nailed it. I was expecting more ESG or conversion questions, and you guys got there, so thank you for that.
The audience has been very engaging. Thank you for all the questions.
But this is just really great questions, and I thank you again. Hopefully you guys found this fruitful. It's nice for us to come out and hear what you guys are on your mind as well, so we're tracking the data.
I certainly learned a lot from all the questions, so thank you for that.
Thank you, everyone.